Well, Blue Financial Services reported a 15% climb in first half headline earnings per share to 0.46 cents. The group attributes the increase to its turnaround strategy, which focuses on cost reduction specifically. Joining us for a look at the numbers is Johan Meiring. He's CEO of Blue Financial Services. Thanks so much, Johan, for joining us this afternoon. So
Good afternoon.
I went through the headline numbers there, but net profit after tax seeing an improvement of 11.6% as well. Operating profit up 91%. I mean, this is quite a turnaround that we're seeing compared to the business we were looking at back in 2010.
Yeah, it's the results of the turnaround that is starting to come through, and it's the result of a whole wide range of different aspects. And I suppose it's basically just focusing on the fundamentals of the business, getting the costs under control, making sure that the quality of the new credit is within acceptable norms.
Mm-hmm. What are acceptable norms?
Well, I think it obviously depends on a per country basis what the impairment rate should be, but mm-hmm. the weighted average for us across all the different operating entities that we have on all new lending is less than 5%, which I think is very satisfactory given the circumstances.
Johan, let's go back a bit now for people that are not familiar with Blue Financial Services. There's a lot of new investors in the market over the last 2 or 3 years as the JSE has embarked on this bull run that we're currently enjoying. I don't know if you can see this now, but you probably can't. But this is a chart that represents your share price at sort of R6 in between 2008 and 2009, and then coming down precipitously. Has your business materially changed since then? Perhaps we ought to go back a little bit and contextualise the current results we're looking at.
Yes, I think the business before 2010 and the recapitalisation and the business today are fundamentally different. Whilst it is true that we still do lending, I think everything else in the business has been changed. So if you look at the way that Blue operated pre-2010, there was a massive increase in geographical dispersion. In other words, they were growing between the different countries at quite a fast rate, going to the 12 odd countries. However, the problem to a certain extent is their revenue growth couldn't keep up with the expansion. And then to a certain extent, they needed to grow their business in one country, which was South Africa. And then unfortunately, the impairments that they were hit with were in excess of 70%. The business today is more diversified, so we're growing in all the jurisdictions and making them all stand on their own feet as independent operating entities.
Mm-hmm. And what kind of growth rates are we looking at when you do venture into these territories right now, so that it is sustainable growth that we're actually looking at?
Because we're operating in 12 countries, we can actually apply our capital where we get the best weighted return on it. So to a certain extent, there's no need for us to grow fast in any specific jurisdiction, and we can spread the risk between the jurisdictions, which then gives you overall a relatively good growth, but per jurisdiction and per operating entity, a much smaller growth rate, which is much more achievable and sustainable. Talk
us through how you're managing risk right now, because I mean the total historical credit impairments, excluding the provision on the previously written off book, improved from 44.9% to 43.7%, and this is as you still continue to strive to cater to underserved and underbanked communities on the African continent.
It's important just to understand this statistic in context. The actual lending default rate on all new lending since the recapitalisation in 2010 is actually less than 5%. The statistic that you're referring to is also some of the success we've had in clawing back on the previous impairments. Mm-hmm. So the previous impairments around about the time of capitalisation was over 50% of the entire portfolio, which has now come down to the percentage as you have mentioned.
Mm-hmm. Johan, you say that the company's attention and resources for new lending will continue to be directed at East and West African countries where GDP growth rates are higher and more jobs are being created. Also, I would imagine in South Africa it's quite difficult after the history we've just spoken about for you to muscle in to the environment where there are significantly bigger and more well-established players.
I think the difficulty in the South African market is just the penetration of unsecured lending. I think at the moment, I would think if the penetration is not almost 100%, it must be in the 90%. So I think the ability for to lend into the market on a responsible basis is very restricted right now, specifically in the section that we address.
Okay, just taking a look at your exposure in Kenya, let's say. I mean, how are you assessing the competitive landscape there specifically? Because where you're catering to an unbanked market, I mean, we've seen, and I was trying to pull it up before you ended your answer there, Equity Bank today saying profit for the first 9 months of the year rising nearly 30%. And that, one of the players in that market that caters to an unbanked population as well.
Absolutely. I think in all the markets that we operate in, there's usually a strong player or a market leader, which I think is normal. And the way that we try and find is opportunities for ourselves in each of the market segments. And that's why even though there's complexity in trading over 12 countries, there's actually a lot of advantages as well. Because if, for example, as we've discussed in South Africa, it is not the right time in the cycle for us to try and grow our business aggressively here, it does allow opportunities in other jurisdictions. Same would apply to the Kenyan markets.
Yeah, and what's your client base? I mean, we're talking about the competition here, and we're talking about the fact that certain of your competitors have stolen a march on you. You talk about the difficulties of doing business in South Africa, given your current situation, and you're focusing on jurisdictions north of here. But what is your client base? And is that client base a client base that might be, for example, of interest to some of the bigger players in the future, and there could be a chance of some corporate action?
Well, I think, first of all, the reason why we focus on countries where the GDP growth rates are higher is because clearly the higher the GDP growth rate, the more new customers come into the market, which we can then attend and serve. So in other words, there's a natural process for us to try and increase our customer base. In relation to the second part, whether the other players would be interested in it, I'm sure that there would be, but that would purely be speculative on my side at present.